Relevant costing. Relevant costing. What do we mean by relevant cost? Relevant costs are the differential future cash flows that arise in direct consequence of the decision. The differential future cash flows that arise in direct consequence of the decision. Relevant costs are the differential future cash flows that arise in direct consequence of the decisions. Now, let's examine the key concepts or key words from the definition. The first key words or key word I'm going to look at is differential. The first key word is differential. What do we mean by differential? Differential means changes. Meaning that for a cost to be relevant, it must be a cost that changes with the decision. Costs that remain fixed are not relevant. Irrespective of the decision you are about to make, or irrespective of the decision you are taking, or irrespective of the decision you are making, any cost that will not change is not relevant. 2. Future. All relevant costs are future costs. They are future costs. Any past costs are not relevant. Past costs, that is costs incurred before the project is launched. Costs incurred before the decisions are taken are not relevant. Past costs are called the sunk costs. Sunk costs are not relevant. 3. Cash flows. Cash flows. For a cost to be relevant, it must be a cash flow. Non-cash items are not relevant. Anything that does not involve the flows of cash are not relevant. Example of non-cash items are depreciation, and amortization. All these items are not relevant. Profit or loss from sales of non-current assets, from sales of non-current assets. Non-current assets. Provisions. Provisions are not relevant. Anything that does not involve flows or cash are not relevant. All relevant costs are cash flows. Direct consequence of decision. Direct consequence of the decision. Consequence of the decisions. Any costs that are incurred as a result of that decisions are relevant. Meaning that relevant costs must relate to the decision you want to make. It must be the costs that are incurred because of that decision. If that cost cannot be traced to that decision, such costs will not be relevant. Try to subscribe to this channel to keep up with the video as it will be dropping to this channel from time to time. So in this aspect, we are going to cover one-off contracts. One-off contract. Then we will cover make or buy decisions. We will cover shut down decisions. Then we will as well cover further processing decisions. So now we want to look at the breakdown of the concepts of relevant costs. We want to break it down. Number 1, we have materials. what are materials? Materials are the substances from which goods are manufactured. Substances from which goods are manufactured. These materials can be categorized into two, but materials. But materials are materials that are specifically purchased because of the project under consideration. That means if that project is not to be carried out, such material will not have been bought. The purpose of purchasing this kind of material is because of the project. That means because of the bought-in materials can be traced to the project. Since it can be traced directly to the project, it will be relevant. It's a relevant cost because it can be traced to the project. Then, the second category is existing materials. Existing materials. By existing materials, we mean the materials that have been bought sometime in the past. Materials that have been bought sometime in the past. Meaning that they are not just being bought for the project. They might have been bought sometime, maybe for one project in the past, and those materials were not used up. So the remaining ones now, that's what we mean by the existing material. Material bought sometime in the past. So these materials now, we are going to break down the cost of that materials into three. The purchase price. Purchase price. Purchase price means the price that material were bought as at the time of the purchase. Since these materials are not just being bought, they have been bought sometime in the past. The purchase price of that material at the time of the purchase of that materials are sunk cost. The purchase price of such materials are sunk cost. And we said that sunk costs are not relevant. We said sunk costs are the past costs. And for a cost to be relevant, it must be a future cost. Therefore, the purchase price at the time of the purchase of an existing materials are not relevant. Then, we can also have replacement price. Replacement price. Or current market price or current market value. By replacement price, we mean the price at which the materials can be bought currently. Remember, these materials have been bought sometime in the past. If you want to buy such materials or materials of that type now, how much will it be bought? That is what we mean by the replacement price. This price will only be considered to be relevant where it can be ascertained that the materials are frequently used by the organization. Meaning that if it is frequently used, the moment the existing one are exhausted, the moment the existing materials are exhausted, you will need to buy another one again. That is why the replacement price will be considered where it can be ascertained that such materials are frequently used by the organization. So I've told you that where it is frequently used. So, frequently used. So, meaning that it is the wording of the question where you can see any word that means the same thing as used regularly, used frequently, used regularly. Any word that have the same meaning with that. So where you can see it in the wording of the question, then you know that the replacement price will be used, or the current market price of that materials will be considered. Then we have net realizable value. Or the disposable value, or the disposal value. Realize means to sell. It means if you don't need the materials again, what will you do? If you can sell them, you will think of selling them. Where the materials are no longer required, then you use the net realizable value as the relevant cost of the materials. That means before the net realizable value can be used as a relevant cost of the materials, you will have been told that such materials are no longer required. So when we proceed, we will talk about, when we get to the opportunity cost concept, then we will look at the opportunity cost of materials. And we will equally take a comprehensive work example to illustrate that. That is for materials. The second one is labor. Before labor, let me talk about sunk costs. I've told you that sunk costs are the past costs. Sunk costs are the past costs. The costs incurred before the projects are launched. The costs incurred before the projects are undertaken. That is what we mean by the sunk costs. Example, we have the cost of drawing the memorandum of association of the company, the cost of conducting the research, the preliminary expenses. All those expenses incurred before the projects are undertaken are not relevant. Sunk costs are past costs. Since the decision is about the future, sunk costs are not relevant. Then the third one is labor. Labor are human effort, both mentally and physically, using the production of goods and services. Then for our purpose, I'm going to categorize this labor into two: the full-time workers or full-time laborers, and the part-time workers or part-time laborers. The full-time labor or full-time workers are called salaried workers. They are called salaried workers. They receive salary. The salary paid to them are fixed. And we say relevant costs are differential costs. That is, relevant costs are changes costs. Therefore, the salary paid to a part-time worker, the salary paid to a full-time workers are not relevant, since it is a fixed cost. The salary paid to a full-time workers are not relevant, since it is fixed, except where the full-time workers are made to work overtime. The overtime will be considered, where the workers are made to work overtime. Then, for part-time workers, these people receive what is called wages. The wages paid to a part-time workers is a variable cost. Wages paid to a part-time workers are variable costs, and relevant costs are differential costs. Therefore, this will be relevant, to be a relevant cost for the decision purpose. That is for the labor. So the opportunity cost of labor will be considered under the concept of opportunity cost. Under the concept of opportunity cost. Number 4, we have opportunity cost. Opportunity cost. Opportunity costs are the value, or is the value of benefits sacrificed in expense of others. The value of the benefits sacrificed in expense of others is said to be the opportunity cost. And that is why we used to say opportunity cost is the alternative forgone. So meaning that before you can apply opportunity cost, you must have more than one alternative. Alternative means more than one option. You can have option A, B, and C, or A and B, or you might even have more than 3. So it is then that you can apply opportunity cost. You want to, out of these 3 options, you want to consider which one will be more beneficial to you. Which one will you prefer out of the 3 options? That is when to apply the concept of opportunity cost. You want to consider the one that will be most profitable to you out of the 3 options. That is when to apply the concept of opportunity cost. Opportunity cost is the alternative forgone. Maybe you have been engaging in manufacturing of product X. And this product X used to fetch you, used to produce 2,000 units of product X. and it fetch you contribution of $5 per unit. A new product has just been discovered, and you equally want to produce this new product, and this one will fetch you contribution of $10 per unit. And the resources you have been using in manufacturing product X will need to be diverted to this product Y. If you divert the resources from product X to product Y, that means the contribution you have been gaining, that is the 10,000, 5 times 2,000, which is 10,000 contribution, which this product S will have fetched you ordinarily. If product X were to be manufactured, that contribution will be forgo. That means the opportunity cost of manufacturing product Y that will fetch you contribution of 20,000, 2,000 times 10, which is 20,000. The opportunity cost of manufacturing this product S is that product Y is the product X you are going to forgo. Since you will forgo this 10,000 from product X, it will be considered as a cost of manufacturing product Y. That is the opportunity cost of product Y. That is how we can have opportunity cost of materials, we can have it for labor and other. So that is for that. So fixed overheads. Fixed overheads. This one, we are going to categorize it into two. We have the general fixed overheads. General fixed overheads. And we have specific fixed overheads. General fixed overheads are fixed overheads that will be incurred whether the projects are launched or not. Whether you engage in production or not, these fixed costs will still be incurred. That fixed cost that will be incurred whether the decisions are taken or not, or whether you are making that decision or not, that is called general fixed overheads. That means it will be fixed, irrespective of your decision. So general fixed overheads are not relevant, irrelevant. So anytime you see general fixed overhead, the fixed overhead that will be incurred, whether the projects are launched or not. So that one is not relevant. Then we have specific fixed overheads. They are specifically incurred because of the project. Meaning that these fixed costs were incurred as a result of the project you want to carry out. If these projects are not to be carried out, such an amount of fixed costs will not have been incurred. That means you can avoid it. Avoidable fixed cost. You can use such term for it. Avoidable fixed cost. If you want to avoid it, that means you avoid the project too. If you don't want to carry out the project, this fixed cost will not be incurred. But the moment you want to carry out the project, this fixed cost will be incurred. You can as well call it incremental. Incremental fixed cost. That is an extra or additional fixed cost incurred as a result of that project. That is incremental fixed cost. These costs are relevant. This one are relevant. I've told you that general fixed overheads are not relevant, but the specific fixed overheads are relevant. Then when you have overheads attribution, overheads recovered, overheads allocation, overheads absorption, etc. Anytime you see any of these, they are not relevant. The following items are not relevant. Number 7, we have non-cash items. Non-cash items. We said relevant costs are cash flows. That's why we said they are differential cash flows. So we said that non-cash items are not relevant. So we therefore want to take a comprehensive work example from ACCA study test by Kaplan, F5, ACCA study test by Kaplan. Mr. Smith has been asked to quote a price for a special contract. He has already prepared his tender, but has asked you to review it for him. He has pointed out to you that he wants to quote a minimum price. He wants to quote a minimum price as he believes this will lead to more lucrative work in the future. Mr. Smith's tender. This is Mr. Smith's tender. He has a material 1A, 2,000 kg at $10,000 per kg. B, C, and D with the value. Labor, skilled, semi-skilled, and unskilled. Fixed overheads. Cost of preparing the tender. We have Mr. Smith's time. Other expenses. We have the minimum profit. 5% of total cost. Then we have minimum tender price as given. Other information. Material A. Material A, 1,000 kgs of this material is in stock at the cost of $5 per kg. This material A, since it is in stock, that's to show that material A is an existing material. And the 5 naira per kg is the price at which material A was bought, since it had been bought sometime in the past. This 5 naira is a sunk cost. And how many kg of material A will be required? 2,000 kg of material A will be required for the project. And 1,000 is in stock. That means they will have to buy another 1,000. So the 1,000 that will be bought in, the current market price will be the relevant cost of that 1,000 that will be bought in. But for the 1,000 in the stock already, that is the existing material, let's see what the price to be considered for that. Mr. Smith has no alternative use for this material and intends selling it for 2 naira per kg. He has no alternative use for it. But he intends to sell it. Since it is no longer required, he doesn't have an alternative than to sell it. That means the realizable value will be considered. However, if he sold it, if he sold any, he would have to pay a fixed sum of $300 to cover delivery cost. The current purchase price is 10 naira per kg. So, if you want to buy another one now, it will be bought for 10 naira. Since he has no alternative use for the material A, that is to show that the purchase, the realizable value will be considered as the relevant cost of the existing materials. So, if you look at the requirements, you have to calculate and explain for Mr. Smith what you believe. Calculate and explain for Mr. Smith what you believe the minimum tender price should be. So, Mr. Smith, you want to determine the minimum tender price. So, we want to start with materials. Material A. We said the material A, we have the bought in, the one that have to be purchased. 1,000 have to be purchased. That is 1,000 kg at the current replacement price. The current purchase price is $10 per kg. So that $10 will be used for the 1,000 that will have to be bought in, and that will give us $10,000. The existing material A, which is 1,000 kg, already in stock. 1,000 kg already in stock, which is an existing material A. So, we say since this existing one, there is no alternative use for it, and you have not been told that it is regularly used, you are only told no alternative use for it. Since there are no alternative use, the only option is to sell it at $2 per kg. And if you sell it, you have to incur $300 to deliver it. That means the net realizable value will be, so 1,000 times 2, that will be 2,000. 2,000 minus delivery cost of 300. Therefore, the net realizable value of the existing material A will be $1,700. Material B. There is plenty of material B in stock, and it costs $18 per kg. If you look at material B, you have plenty in stock. Plenty of material B in stock, and it costs $18 per kg. The current purchase price is $15 per kg. The material is constantly used by Mr. Smith in his business. It's constantly used. The use of the word constantly used, it shows that if the ones in stock is exhausted, there will be need for you to buy another one. Therefore, the current replacement price will be the relevant cost of material A, of material B. You have plenty in stock, and it costs $18 per kg. The one you have in stock, as at the time of purchase, it was bought for $18. And the purchase price at the time of purchase, since it has been bought sometime in the past, I've told you that that purchase price is a sunk cost. That is the past cost. And I've told you that the past costs are not relevant. But since it is constantly used, I've told you that where it can be ascertained that the materials are used regularly, that you use the current market price or the replacement price. So the current purchase price is $15 per kg. So that will be considered as the relevant cost of material B. So, and the quantity you need for material B is 1 kg, 1,000 kg. So you have material B, material B. You need 1,000 kg at $15 per kg. So that will give us $15,000. Material C, material C. We're told that the total amount in stock of 500 kg was bought for 10,000 some time ago. What you have in stock for material C is 500 kg. And these have been bought some time ago for 10,000. Since it has been bought in the past, the 10,000 are past costs. And we said that the past costs are sunk costs. Therefore, this 10,000 will not be relevant. For another one-off contract that never happened, it was bought for one contract that never happened. Mr. Smith is considering selling it for 6,000. He is to sell it now. He will realize $6,000 from it in total, or using it as a substitute for another material constantly used in normal production. Now, you can decide to sell it for 6,000, period, or to use it in place of another material which you normally use regularly. That means, since you have more than one option, I've told you that this 10,000 is not relevant because it is a past cost. But you want to decide between these 6,000. That is, you want to decide between selling it for 6,000 or to use it as a substitute for this alternative material. If used in this latter manner, it will save 8,000 of the other materials. The current purchase price is $40 per kg. If you want to buy another one, you will buy it for $40 for 1 kg. So that means you can decide, since it is already in stock, and you want to decide whether to sell it off for 6,000 or to use it as a substitute for another materials for this job. And if you use it as a substitute, $8,000 will be saved. So between these 6,000 and 8,000, which one will you prefer? Will you prefer selling it for 6,000 or to use it as a substitute for another material and save 8,000 you will have incurred on that contract? You know, if you do not use it in this contract, you will have to buy another material that will be needed for the job, and that will cost you 8,000. But if you now want to use it now, then the 8,000 will not be incurred in this contract you want to undertake. So ordinarily, you will prefer using it in the contract and save the sum of 8,000. So the opportunity cost of selling is 8,000. That is, you will prefer using it in the contract and save the sum of 8,000 to selling it for 6,000. So that is for material C. That is the opportunity of the material C. So opportunity cost of material C is 6,000. Opportunity cost of material C is 6,000. I mean, 8,000 opportunity cost of material C is 8,000 that will be saved. Then, material D. If you look at this contract, you need 50 liters of material D at $12 per liter. So, and if you go by the note here, material D, there are 100 liters of these materials in stock. You have 100 liters in stock already. And what you need for this contract is 50 liters. That means material D2 is also an existing material. It is dangerous. And if not used in this contract, we have to dispose of at a cost to Mr. Smith of $50 per liter. Now, you have the opportunity cost of this material. You either use it in this contract or to dispose it of. Since you have more than one alternative, so you want to decide. That means you are going to apply the concept of opportunity cost as well. There are 100 liters in stock. And what you need for this contract is 50 liters. It is dangerous. Since it is dangerous, and if not used in this contract, it will have to be disposed of at a cost of, to Mr. Smith of $50 per liter. The current purchase price is $12 per liter. If you want to purchase it currently, it will cost you $12 per liter. That is for material D. So what you need is 50 liters. Material D, material D. You need 50 liters. Then, if you want to dispose it off, That means if you don't use it in this contract, the opportunity cost of it is to dispose it off. And to dispose it off, it will cost you $50. $50 at $50 per liter. And that will give you 50 times 50. That will be 2,500. That is a cost to Mr. Smith. Since it is a cost to Mr. Smith, that is why it will be treated as an outflow. So, because Mr. Smith is going to expend it, it is going out, and it will be treated as an outflow. Then, skilled labor. Mr. Smith only hires skilled labor when he needs it. If you look at the skilled labor here, you have 1,000 hours at $25 per hour. That is for skilled labor. 1,000 hours at $25 per hour. That is the skilled labor required. If you go by the note here, Mr. Smith only hires skilled labor when he needs it. So, since it will be hired at the time they are needed, that means they are part-time. They are part-time workers, not full-time. $25 per hour is the current hourly rate. Since skilled labor is a part-time workers, I've told you that the wages paid to the part-time workers are relevant. You need 1,000 hours, and the current rate is $25. So that means you have skilled labor. So you have labor, you have skilled. 1,000 hours at $25 per hour. And that will give us $25,000. Then, semi-skilled labor. Mr. Smith has a workforce of 50 semi-skilled. If you look at the semi-skilled required here, it's 2,000 hours at $15 per hour. You need 2,000 hours of semi-skilled at $2,000 per hour. Go by the way of note. Mr. Smith has a workforce of 50 semi-skilled laborers who are currently not fully utilized. So that means there are 50 semi-skilled. Since they are not fully utilized, that shows to show that they are full-time workers. And those people will receive salary. They are on an annual contract, and the number of spare hours currently available for this project are 1,500. The available one is 1,500. So that 1,500, they will receive salary for that 1,500. So it will not be considered. Any hours in excess of these will have to be paid for at a time and a half. And don't forget, since those people have been employed, 50 workers, they have been employed, and those people will work for 1,500, and they will be receiving salary. Whether this project is undertaken or not, they will still receive that salary. And the salary paid to them are fixed. And I've told you that relevant costs are changes costs. So since that salary is fixed cost, it will not be relevant. So the only one that will be relevant is the extra. Since the time required for semi-skilled is 2,000 hours, and the workers will only work for 1,500, the organization will be in need of additional 500 hours. The additional 500 hours now will be paid at a time and half at the normal rate of $15. So now we calculate that. So we have semi-skilled, labor. It is the extra 500 which will be paid at the rate of $15 per hour. and they will be paid at a time and half. A time, which is 1, and half. So this will give you 1.5. 500 times $15 times 1.5. That will give us 500 times 15 times 1.5. 1.5, no, 1 divided by 2 is 0.5 plus 1 to be 1.5. That's how I got 1.5 here. So that will give us 11,250. That is for semi-skilled labor. Unskilled labor. These are currently fully employed by Mr. Smith. Since they are also fully employed, that means they will receive salary. But let's go further. Unjust, where they produce a contribution of $2 per unskilled labor hours. Their current rate is $10 per hour, although extra could be hired at $20 an hour if necessary. Now, this unskilled labor, you either make use of the one employed, or if you make use of the one employed, then that means those workers will remain, the work they ought to have carried out elsewhere, no one will be engaged in that. So you may want to consider employing other people to work in this very contract. That is, since you have two options there, that is opportunity cost here. But this $20 for extra is too expensive. So ordinarily, how much will you pay them? They are currently fully employed, these are currently fully employed by Mr. Smith on just where they produce a contribution of $2 per unskilled labor hours. Their current rate is $10. So if you want to divert these workers now to work in this contract now, the $10 you will pay them per hour will be for good. That is opportunity cost. The contribution you will have get from where they currently work of $2, 2 will be for go. That means the opportunity cost now, the amount that will be for go will be $2 contribution plus 2 plus 10, making $12. How many hours now will be required for unskilled labor? 500 hours. So the opportunity cost of unskilled labor now, unskilled labor, we have 500 hours times $12, and that will be 500 times 12. That will be $6,000. $6,000. Now, fixed overheads. If you look at the financial statement, fixed overhead is 3,500 hours at $12 per hour. Then if you go by the way of the note, this is considered by Mr. Smith to be an accurate estimate of the hourly rate based on the existing production. So it's an estimate. It's not the real one. It's an estimate. It's absorbed. It's the one charged. It's the one attributed. It's the one recovered. And I've told you that overhead absorbed or overhead recovered. I've told you that is not relevant. So we have fixed overheads. Fixed overheads, since it is an estimate, estimated fixed overheads is not relevant. Cost of preparing the tender. Mr. Smith has spent 10 hours working on this project at $100 per hour, which he believes is his charge out rate. The cost of preparing that is not relevant. Other expenses included in the cost of travel and research spent by Mr. Smith on the project. So we've told you that those ones, research costs, we said they are sunk costs. So cost of preparing the tender, cost of preparing the tender is not relevant. Then other expenses, since it is for research, the amount spent on research is not relevant. I've told you that research costs are sunk costs. They are not relevant. Profit markup is not relevant. So we don't consider it, since it is minimum price. So you don't consider the profit markup. So when you sum it up, you get the minimum acceptable price. So the total will be total will be 74,450. 74,450. That is the minimum price. So that is for a one-off contract.